Good afternoon. Welcome to Credit Suite Live. Today, we are going to be talking about which real estate loan is right for you and breaking down some great ideas and some great tips for getting your real estate investing business up off the ground. I'm going to share with you some big success stories and tactics that we've seen our clients use to be able to get into the real estate game with relatively no money out of their pocket, using different types of loans, different types of financing options that may be available. So we've got some stuff to cover here, and today, normally we're on several different platforms, but today we are just here on YouTube with you guys. So if you have any questions, throw them in here. More than happy to answer them and make sure that we're getting your questions answered. So before we jump into it, if you like business loans, you like business lending, we actually have a challenge going on right now. It's called the Business Loan Broker Challenge. We are Ty is actually live over there now doing that. It's a lot of fun. We've got several people that are. We've got hundreds of people actually who are looking at getting into business financing over there, learning from us. Great time if you're interested in that. I threw the link in the chat there for you to jump in. So let's dive into commercial real estate loans, and let's start talking about this. So when you're looking at commercial real estate, there's several things that you need to know. First off, the thing that's good about commercial real estate is that it is a secured asset. It's an asset that can be secured to use loans. So what you're going to find is that there can be some flexibility there. The other side of it is when you're looking at getting into commercial real estate, there's a couple things you need to decide. Like first off, what's your strategy? What is it that you're trying to accomplish? Are you looking for fix and flips? Are you looking at a buy and hold strategy? Are you looking at getting real estate just for your business alone? So these are some of the things that you have to think through up front. What is your actual goal for getting into real estate? What is it that you want to try to accomplish? And then from there, what you need to determine is one, does your business have the cash flow? Is it something that you're going to be able to make sure that you have the ability to get a business loan, that you've got the money there to handle it? And then you have to look at some of the other factors and compare them. So as we're talking about different real estate loans, I've got four different options mapped out. The last one is very unique. It's something that a lot of people don't talk about, but I think it can also be one of the surprising ways that I've seen that's worked really well for people and has kind of a win-win synergy to it, which is powerful. But we're going to kind of start from the bottom up. So the first rung, I guess, of what you would consider for commercial real estate financing is going to be hard money lenders. Hard money lenders, they're just that. Basically, what they're doing is instead of going through the traditional banking system or having a bank and using the deposits to be able to make loans, they're taking people who are invested in REITs, or REIT is how it's spelled. It's a real estate investment trust. It's a security instrument, basically, where banks and lenders like this are able to go out and actually raise capital to be able to lend out to people. With these hard money loans, their rates are going to be higher, their fees are going to be higher, their terms are going to be shorter, but the flexibility is completely different than going to a traditional commercial bank. So, for example, when you're looking at traditional commercial lending, a lot of times what you're going to find is that they're going to want to see 20, 25, even 30% down. If you own personal property, they're going to have you secure that. And this includes SBA loans as well. They're going to use that to secure the loan. But with hard money lenders, the thing that's really nice about it is you can get in with about 10% down. Now, hard money lenders, traditionally, what you're going to find is that they're short term. They're not, it's not something that you're going to get a 25, 30-year amortization on, or maturity is what they call it in the real estate lending game, meaning that after about 20 or 25 years that the note is due in full, but it should be paid off at that point. But typically, you're going to find that it's terms that are 6 months, 6 to 18 months. But these hard money lenders really prefer doing short-term investments. So they're looking at like fix and flip properties. They're looking for if you can find something that's relatively easy to make a profit on, you can buy it, make interest only payments on it, and then turn around, sell it. Bank gets their money, you get your money, the third party gets their property. Everybody walks away happy. It's a great way to do it. But that's really their niche is right there inside the fix and flip industry. But there are some options with some of the lenders that will work with you if it's something that you're buying for yourself. Now, the way you could structure some of these short-term financing options, you could actually look at it as a way to quickly acquire a property, especially if you're finding it's undervalued, you can pick it up at a great deal, and then turn around and work on refinancing it into more traditional financing options after a year or two, or once you have the process go once you have some time in there. So it looks like we have McGuire in here. I'm a signing agent client last night. Hard money, 12 months, 13%. Yeah, the short terms, high rates, and then the fees at closing are usually pretty high as well. They're not, but the other side of it is if you know what you're doing, if you know that you're finding a property that you can get into and that you can actually make a good return on quick, it's something that you could you could put together a pro forma on it and make sure that you're actually going to recoup your costs, that the investment, I'll just say in my terms, that the juice is worth the squeeze. What you're paying in interest, what you're paying in fees, still going to give you that positive return on investment, so that it's something that financially makes sense. The second rung of financing for commercial real estate is SBA loans. SBA loans, 504 loan. These are not actually going to be looking at real estate fix and flips. These are going to be more of your long-term buy and hold strategies. And actually, with the 504, it's not even a buy and hold strategy. This is more for if you're a business and you want to go out and you want to find a loan to acquire your own property. So let's say you want to buy your own property, you want to own a building. The 504, the SBA 504 loan is actually a great option for that. Now, the thing that's nice about the SBA 504 loan is that you can actually buy this commercial real estate and you can buy an office building and use it as a rental, meaning that you would have the ability to have a positive cash flow on the property and actually make money off of the loan, become the landlord, own the property that you're already operating out of, and then if it has the capacity for other people, for renters or other businesses being in there, it's a great way to be able to get access to that. Does SBA do anything special for disabled veterans? They do have some options. I don't know exactly how it pertains to the real estate side. So nothing in particular. Most of the time, what you find with SBA loans is anytime they're dealing with one of the minority classes that they're trying to encourage economic development in, that they're going to give discounts on rates and fees, and they don't really waive their requirements because the requirements are more of a safety feature for the bank and the lenders and everybody involved. But they will give discounts on rates and fees with that, and work on that. Plus write-off depreciation 39 years. I believe that is correct. That side is not my expertise, so that's a great point in that. So with the SBA loans, the nice thing about the SBA loans is when you're looking at financing with SBA, you're going to be looking at longer terms, meaning that you can get into a 10-year, 20, or even 25-year maturity terms, meaning that you could have it basically off of a 25-year fixed payment, or a loan that's due in 25 years. One thing to understand about commercial lending, though, is unlike residential lending, you don't always necessarily get to lock in your rates for the full amount of time. So a lot of banks will not so much SBA, but as we get into traditional banking, we start working with traditional lenders. You're going to find that they're going to adjust the rates according to what prime is, because they don't want an SVB situation where now they're sitting on top of all these loans that are underperforming. They can't make money on them. It just turns into a mess. So a lot of times what you'll find is that, especially as you start getting into the more complex finance and you start looking at blanket loans, you start looking at banks that are covering your entire portfolio with that, that those rates are going to be adjustable. They may put you on a 12-month fixed plan, but then that payment's going to go up or down depending on what the market's doing. Right now, in our current environment, it just seems like it only goes up, and that's all it really does. But that actually rolls right into some of the other things about 10-year variable. Yes, they do have fixed rates. There's 10 years available, and some of these are questions that get a little more in depth in the sites that I work on with Credit Suite. But a lot of them do have variable rates, or they do have variable rates. I have seen them. I've seen several of them that have locked for 1 year, 3 years, 5 years. I've never personally seen 10-year variables, but I have heard of it. I do know it is something that is available with that. The top rung, basically, when you're really starting to dive into when you start diving into commercial real estate, is traditional financing. This is actually more dealing directly with banks. The difference between traditional bank loans and SBA loans is that when you're working with an SBA loan, the government is securing a certain percentage of it. I believe a lot of times it's like 65% of the loan amount. The government is actually going to secure that, meaning that if you default, that they can actually recoup their costs. Is SBA a personal guarantee? Yes, all SBA loans do require a personal guarantee on them, which makes it a little bit trickier. And it's not just you, but anytime you're looking at the traditional and the SBA, it's any partners that are in your business. And one of the things that most people don't talk about, but when you start getting into traditional banking loans, if let's say they go through your tax returns, they look and they see that you're applying under company A, and company A is very well qualified, and you don't have any partners, you own it directly, and you can guarantee. But when they start looking at your tax returns and they see that you have company B and company C, if company B and company C have partners in them, they have the right to actually go and request information from those other two partners as well, just to make sure that the loan isn't upside down. And as intrusive as it may sound, from a bank standpoint, what they're looking for is they're looking for some of the killers that are out there. So, like if somebody's dealing with a federal or a state tax lien, if you get an SBA loan or any type of commercial real estate, any type of loan, the government can basically come in and seize that asset. And so that's what banks are doing. Excuse me. The banks are really just protecting their interest in the loan, making sure they're not going to go upside down with it, and work to make sure that their investment is properly managed with it. Anytime you're looking at traditional financing or liability risk, that's a great way of putting it. Anytime you're looking at traditional financing or SBA, some of the requirements is they're always going to want to see 2 to 3 years of profitable tax returns. The reason they want to see profitable is because profitability is how much money you're making on top of all of your expenses, meaning that if you're going and you're trying to take out a loan, they're going to calculate how much you can afford out of the profit of the company. If the company is not profitable, it means that there's no extra room for you to make money or to make that payment on it, and they know that's a sign. So they're going to be looking at that. They're going to be looking at your reserves. They're going to be looking at any assets that you have available. They are going to look for a personal guarantee. Personal credit, and this, I think, it really plays with traditional banking and SBA as well. The two are pretty closely associated, except for a lot of the functionality on the back end, what happens. But they're gonna look at your personal credit. There's not like any hard set. You have to have 680. You have to have 700 requirements. SBA, we've seen people in the high 500s actually get approved for SBA loans because there was a lot of other compensating factors. So their personal credit wasn't good. Their business had credit that was good. They had the reserves. They had plenty of profit, plenty of cash flow. It's just their personal credit taking a hit. And a lot of times with the banks, especially when you're dealing in the hundreds of thousands and millions of dollars, they're going to use common sense with it. Where if you've got let's say you've got you have a credit card, $100 credit card, that for some reason the payment didn't get made, and that late payment shows up and just dings your credit, knocks you down for a month or two. They're going to look at that and use a little bit of common sense to go, and you know what, they've got all these other accounts that are being paid. This is just a one-time hiccup, and they'll make sure that it's up to date and they'll move forward with it. So your personal credit is going to play a factor into it. But as long as there's nothing major, the one thing to keep in mind is they're looking at the risk. That is their number one thing. Their job, their entire job as a bank is to make money and to reduce as much liability as possible, to reduce the risk to the point that the investments that they're making with their consumers that are depositing money in their bank is getting a positive return. So a lot of times as you're going through this, that's what you have to keep in mind. It's not necessarily like this secret formula of, okay, I got a 680, okay, I've got 100,000 in profit, and now I'm going to be able to get a loan. It could be, you know what, my credit's a little lower, but my profits are high. My profits are not quite where I want them, but my credit's good and our payments are good. So as long as there's compensating factors, they're going to take all of it into consideration. When you talk with a banker, and if you ever have this opportunity, it's a really cool thing to ask them how they go about the process. They have a software, and they do this thing called spreading. And what they do is they take all your tax returns, all your assets, all your statements, and they put it inside of the software platform. And basically, it just takes it, and I think of it kind of like an Iron Man, where he's sitting there and he goes poof, and all these things just come up really big. And that's basically what the banks are doing. They take all the information, they put it inside the software, and from there they're able to look at it and make a real calculated risk based on all the different factors that are out there. And so with that, that's what you want to keep in mind as you're looking at getting into this, because part of the process of getting to that point that you're getting the traditional loans, that you're getting SBA financing, is that you do have to have a profitable business. And one of the impacts of having a profitable business as the business owner or the person responsible is that if the business is profitable, it means you've got plenty of money, so your credit in theory should be pretty good. And we all know that there are issues and there are situations that happen, but at the end of the day, what they're looking at is okay, if you're making a profit, is your personal finances, or is your personal credit good, or are you keeping all the money inside of the company because you're a ticking time bomb personally that could cost the banks money. Does SBA report to the credit agencies? No. The SBA, the best way to think about SBA is for commercial lending what Fannie Mae and Freddie Mac are to consumer lending, where they're more coming in on the backside and they're securing the loans, giving those requirements to the banks. So the banks are going out and that they're lending their money, but they're being secured by SBA. So SBA is not actually loaning their own money. The bank is loaning their money, but SBA is securing the investment that the bank is making because it's meeting the guidelines. Is depreciation added back to profits? Yes, and that's if you ask me the exact amounts, I don't have that information. That's a little beyond my what I've had to deal with in this capacity. The three things that we've talked about so far: hard money lenders, SBA loans, and traditional financing. Those are kind of the three gimmies. The last one that I want to share with you, this is something that's been relatively new that people have been doing the past several years, and I think it's actually a really great strategy, and it's crowd equity funding. So basically, what's happening is that there are platforms that are out there now that allow you to create an LLC, and it may be a temporary LLC that you're investing in a certain property. So let's say you've got building A on Main Street that you want to purchase. Instead of going to the banks trying to collect the money and going through all the hoops of it, what you're doing is you're stepping up and you're actually creating an LLC, and you're bringing people in to invest into the LLC that will buy the building, not the company itself. It's called crowd equity funding because it's not that you're trying to find one person with millions of dollars to invest, but you may be looking for hundreds of people with $10,000 to invest. You're getting the money, you get the return, and then based off that, you can structure your payouts accordingly. Meaning that, like fund rights, yes, that's a great example. That's a lot of what we're starting to see newer trend with some of the companies that are coming out. Is that now you're able to go up, you get the LLC, everybody's investing into it, and you're sharing the profits based off of the amount that you're invested. So if they're looking for $1 million, you put 100,000 in where everybody else is putting 10,000 in. Now you're going to get 10% of the profit that comes off of that property, and that can be monthly profits or quarterly profits based off of if it's a buy and hold strategy, or if it's a fix and flip strategy. Once the property actually sells, then you make money. And I think this is a genius way to look at getting into real estate. It's a smart way if like you're somebody who is a real estate agent, you're constantly dealing with this, or maybe you're a commercial lender and you want to start getting into the actual investor side, but you don't want to jump, you don't want to be messing with the banks, or you've got connections to be able to do some of this. And I've actually seen the first time I ran into the man, maybe this has been going on longer than I think. Have you ever noticed the older you get, the faster time goes by? Right after the real estate crash in 2008, right after the crash in 2008, I actually started running into local builders. I'm in the Kansas City area. I live in Missouri in the Kansas City area, and I started running into local builders at that point who was actually taking on this concept. And before the software platforms came out, before companies started kind of digitizing it and making it where they could easily get in there and do it, the builders were just going out to their real estate agents and networks and different investors that they had locally connected with, and just started saying, "Look, if you give me $10,000 when the property sells, we'll do it that way." And they structured it the same. They had the LLCs, and they were working that way. But it was an interesting concept, and it actually worked for a while. And then the mortgage industry crashed, so I kind of walked away from that and got into credit and more of that side of life. But the crowd equity funding, I think, is one of the things that you're going to see that's on the rise, and especially as we start seeing more and more banks start to have financial issues. People are going to start turning to each other more in a consolidated way to be able to get that. So now, one of the last points that I'd like to talk on, and this is something, a lot of our audience, a lot of the people that we talk to are newer business owners, or businesses maybe been up for a year or 2 years, and you don't really have that. I will say, like when I was on the sales team with Credit Suite here, the one thing that I kept running into were people coming and saying, "Hey, I want to start a real estate investing company, but I don't know where to get started." The one thing that I think a lot of people miss is that everybody's got their eyes on the big prize of the buy and holds, where they can buy these multi-million-dollar properties, or in tens or hundreds of thousands of dollars and revenue coming in annually from the rental. And that is awesome. That's a great place to be, but it takes time to build there. And as a real estate investor, one of the hardest parts about getting started is actually having the cash flow to be able to get out there and do anything. And the trick that we have seen, and this isn't anything that's hidden, it's not even really a trick, but kind of the strategy that we've seen that's worked really well for people, is you start focusing on fix and flips first. The reason you want to do that is because it gets you revenue in the bank quick, meaning that you're able to get out there, you're able to start investing into real estate, get the stuff that you need. Um, you're able to get the money that you need, start building, and start getting the revenue, get the down payment, using all of that, and you start a fix and flip business that funds your long-term buy and hold strategy. Because buy and holds, I mean, just like anything, it's going to have ups and downs. You're going to have renters that leave. You're going to have things that aren't going to work the way that they should, and there's going to be extra costs that are in there. Where if you get into the fix and flip strategy, that's where you can have that consistent cash flow coming in, and it's short term, meaning that once you have your crews, once you've got the system locked down, you can really be generating a lot of money within 60-90 days, and consistently do it, and you can scale it up, and then you've got this cash making machine where now you can start to invest that cash that you're making into some of the longer term buy and hold strategies to be able to work through your vision of what you want for your real estate work for your real estate company. So that's really all I got for you guys today. I've actually got to hop back over to the Business Loan Broker Challenge because we've got a lot of stuff going on over there that I need to get to. But if you guys have questions or you want to find out more, check us out. Check us out at creditsuite.com. We're always happy to talk with you about your situation, what you're working on, and help you come up with some creative ways to be able to fund your business. So appreciate you guys hanging out with me today. Have an awesome rest of your week, and we will see you next time. Thanks a lot.